If you own a stock for over a year, these are the rates that are going to apply to the gains on it. And also if it's a qualified dividend. Again, talk to an accountant. I'm going to jump into a bunch of this and share with you why it makes sense likely for many retirees to have an accountant. But let's go through these. So for married individuals, you can pause this and see the other categories. You can see people pay zero tax up to $96,700 in long-term capital gains and or dividends. And then that rate stays at 15%. It jumps to 20% for people that have over $600,000 of long-term capital gains and dividend taxes. Okay, now let's go. So the U.S. has two basic income taxes. One is for the capital gains, and the other is for ordinary income. That's what this is here. You can see there's 7 categories here. What we don't see is the 0% rate. Okay. So this is zero. It's a 10% tax rate from 0 to $23,850, but this is after the standard deduction has been taken. So you can see we've got the 10% tax bracket and then 12, and then importantly, it jumps. There is no 14, 16, 18, and 20. It goes from 12% to 22%. Now, we're going to want to remember that because it becomes important later. And then we go 22% to 24, and then there's another big jump to 32%. Okay, and you can pause the video to look at what it is. Here, too, is what the earned income tax credit is going to be. You can pause the video to look at that, but I want to jump into what does this mean to all of us. So I showed you where the income tax rates jump from 12% to 22%, from 24%, I believe it was to 32%.